revision session for accounting, and I really trust that today's session will help you in your preparation for any tests or your final exam. So let's see what we have in store for you today. Today we are going to look at the statement of comprehensive income. That's something that you did in the second term. Also the statement of financial position. And then obviously your favorite, we are going to look at the analysis and interpretation. The theory part, and then also we're going to do 2 activities on analysis and interpretation. So let's start with statement of comprehensive income. Now the first thing that you need to know is that what is the purpose of the comprehensive income statement? Now that is obviously you want to calculate the profit, the net profit. That's why we prepare this, in order to calculate the net profit for the year. So everything in the nominal account section goes into this statement. Very important, you must know the format. I always say that accounting is like building a puzzle. When you build a puzzle, you look at the picture. So in accounting, we give you the picture, and that is what I'm trying to do today, give you the picture. And then when we have a test or exam, we give you the puzzle pieces, and then you must be able to fit it in the correct spaces. And that is where the format comes in, and that is a lot of study work. You have to learn that. You have to study that. And I know that you guys always say that accounting, you only have to understand accounting, you don't have to study it. That's not true. There's a lot of work that you have to study so that you know the format, so that you know where the puzzle pieces must go. So please, all your statements, know the format. Then the difference between the statement of comprehensive income of the sole trader and the partnership, there is none. So the statement of comprehensive income that you did last year with the sole trader and this year in grade 11 is exactly the same. The method that I want to teach you to do a statement as effectively as possible and earning the most possible marks as quick as possible. First, you copy all the information from the question paper with the amounts. So you write down, you complete the format. We give you a semi-completed statement. You complete the rest, and you copy the amounts from the question paper. Then you start with adjustment number 1, and you work through all of them, adding, subtracting, doing what you have to do, and then you calculate the final amounts, rent income, a certain amount minus, so calculate that, and then you complete the statement of comprehensive income. You want amounts on your answer sheet, not on your question paper. So as quick as possible, write down information on the answer sheet. But for this, again, format, very important. What you have to remember, adjustments that we often come upon is the accrued income, accrued expenses. Now, accrued, you have to add. Now, for you, it is easy because accrued expenses, accrued income, we have to add. So whenever you're not sure, just check the A. While the income received in advance and the prepaid expenses, that you have to subtract from the amount on the statement of comprehensive income. Possible adjustments, I'm just going to go through all the possible adjustments that we normally ask you, and then obviously there will always be something that you haven't seen before, but at least these that you know how to do, that you get used to the method that you apply when you have to do these. The first thing is when a debtor returned goods. Now, we've taught you in grade 10 how to do the journals and the posting to the ledger accounts, but now how does that influence the statements? First thing, you have to subtract the selling price from sales, because that's debtor's allowance, and we know debtor's allowance decreases sales. Then you also have to subtract the cost of sales from cost of sales on the statement of comprehensive income, because the cost of sales, you are cancelling that transaction. And then you subtract the selling price from the debtors because they owe you that amount less. It's an asset that decreases. and you add the cost of sales to your trading stock. That's an asset that increases because you receive that stock back. Obviously, the first two will be shown on the statement of comprehensive income, and the last two will be shown on the statement of financial position. So if you know this, this is the way we do it. You look for the selling price, you subtract from sales, you subtract cost of sales from cost of sales, the rest goes on the statement of financial position. The next one, trading stock deficit. Deficit indicating it is a difference between what is counted and what we have on record. So you take the original amount that was given, then you add or subtract the adjustment that was made, and then you subtract the on-hand amount that was counted, and that will give you the deficit that will be shown on the statement of comprehensive income. So the important thing, the difference between the record and what was counted. And on the statement of financial position, we will show the on-hand amount, the counted one, the correct one, because that is what we actually have. The one that goes with that one, the consumable goods on hand, that is what we have on hand. In other words, not a difference, but what we have on hand. And we subtract that amount from stationery or packing material or consumable goods, depending on what they give you in the pre-adjustment trial balance. And then you show the counted or the on-hand amount you show on the statement of financial position. Just to go back to that one, sometimes they give you an adjustment which says consumable goods or stationery used during the year. Then you don't subtract, because then they gave you the amount that you are actually showing in your comprehensive income statement. Depreciation. Now, last year maybe this was a challenge, but in grade 11 you've done asset disposal, and now depreciation suddenly is not that difficult anymore. The two methods, know the two methods on the cost price, on the diminishing balance method. Then you must look for information, were there any assets bought during the year? So you must take that into account when you write off depreciation. Were any assets sold during the year? Asset disposal can be part of this question as well. And then the depreciation will be shown on the statement of comprehensive income, and the rest will be shown on the note. And normally this note we will test separately, and that will most of the time be combined with asset disposal. So you must know exactly how that note looks. Bad debts recovered. When a debtor disappears, we wrote off the debt, but now suddenly that debtor appears again and pays us. So we say, thank you very much for the money, we take it, we debit bank, but now we credit bad debts recovered, which is an income to be shown on the statement of comprehensive income. So we will add that. We will just have to see whether a mistake was made, because sometimes when a debtor who was previously written off pays us, then we put it in the CRJ, but by mistake we put it in the debtors control column. So we credit debtors, so then it looks as if that we owe that debtor money, because it doesn't exist anymore. So now we credit that debtor. So if that mistake was made, we have to add the amount to debtors. But if no mistake was made, just the bad debts recovered under income on the statement of comprehensive income. The one that goes with that one, bad debts. Bad debts, you have to read carefully. How much was written off and how much was received? And then sometimes we give you the amount received instead of the amount that the debtor owed us. So read carefully. Is it 40 cents? Is it 60 cents? We received 40 cents, so we must write off 60 cents. The amount that they gave us, is that the amount that the debtor owed, or is that the amount that we received? And then obviously you add that to bad debts on your statement of comprehensive income. Provision for bad debts, we have to provide for possible bad debts. The debtors control that was given, plus or minus any adjustments that might have occurred, bad debts written off, or a debtor that returned goods, so we get our correct amount for debtors control. Then we calculate the correct provision, the 4%, the 5%. Sometimes we give you the amount that it is supposed to be. And then you must compare that to the actual amount that is currently on the pre-adjustment trial balance. And if the provision have to increase, we have to make the provision more. The provision was 4,500 and now the correct one 5,000. Obviously there's a 500 rand to be added that will be shown as an expense. If it's the other way around, it was 5,000 and now we must show it as 4,500. The provision will decrease, therefore it will be shown as an income on the statement of comprehensive income. And the actual or the correct provision will be shown on the statement of financial position. The one that it is supposed to be. If it's supposed to be 5,000, then you show the 5,000 on the statement of financial position. This was your new adjustment that you did this year. Haven't done this last year. This is a new one. Salaries, wages omitted. Maybe the salary journal for the last month was not posted, or there was a new employee and his or her details were not entered. You look for the gross salary and you add the gross salary to the statement of comprehensive income. Sometimes we give you the net salary with all the deductions, then you calculate the gross salary. Sometimes we give you the gross salary. So in all the information, you're looking for the gross salary as well as contributions. So the gross salary, the contributions goes on the statement of comprehensive income. The rest will all go on the statement of financial position. The net salary, if it's not paid yet to the employee, as well as the deductions and contributions, will also go to the statement of financial position under trade and other creditors. So whenever you see this adjustment, you know exactly what to do. You look for gross, you look for contributions on the comprehensive income statement. The rest all goes to the statement of financial position. That was, in short, the adjustments that you've done, or possible ones, and obviously there can be something that you haven't seen before. So now we're going to look at the activity that we're going to do. You'll see that I'm not doing full activities. I've picked a few out of the activity book that can be a challenge for you maybe. The easier ones, obviously, you can do on your own, and you've got the answers for them, so please work through them. We're going to look at activity 2, only 2.1. Later we do the rest of that one on page 5, and in your workbook it is on page 2. So let's see how we're going to do that. Statement of comprehensive income, that is in your activity book, page 5 and 6, and in your workbook it is page 2. They give you information from the records of JJ Stores on the 28th of February 2020. That's actually supposed to be the 29th of February because this is a leap year, the end of the financial year, partners Josie and Jay. And now we have to prepare the statement of comprehensive income. Read through the information. Important thing is you must know what is your financial year. We start from the 1st of March 2019 and we end on the 29th of February 2020. So when you have your financial year and they give you a date, you can identify that as beginning of the year, end of the year, or during the year. So here they tell you that the capital on the 1st of March 2019, so that was the opening balances at the beginning. Then you have the drawings, current account. Again, they show the date, 1st of March, so that is at the beginning. Also look at the balances, debit, credit, but we'll come to that in our next activity when we look at the statement of financial position. We've got sales, we've got cost of sales, and they give us the net profit. So we know exactly what this income statement must end on. Not that it works like that in practice. In practice, we have to calculate that. But just to make it easier for you, we give you the net profit. Then the extract from the pre-adjustment amounts at the end of the year, 28th of February 2020. Loan, fixed deposit, debtors, provision for bad debts at the beginning of the year, 3936, trading stock, rent income, insurance, expenses, and then they give you a question mark for sundry expenses, so that will most probably be your balancing figure. They give you adjustments, and like I said, the first step, you copy information from the question paper. So you fill in sales from the question paper. Please make sure that you use a ruler, that you don't copy the wrong amounts. You complete the format. There where there's open spaces, you know it must be cost of sales, you copy cost of sales. Commission income was given. The other income that was given was rent income, and then insurance, packing material, water and electricity with the amounts given. And interest income, they actually gave you 8,100 there. So that's already given on the pre-adjustment trial balance. And you fill in the net profit. Now you start. So that's step one. You already have marks. You already earned marks because you've already written some information on the answer sheet. Now you start with adjustment number one. Adjustment number one says that the annual stock take revealed the following stock on hand. Trading stock on hand, that is how much we have. That is the counted one. And if we look in our pre-adjustment trial balance, we will see trading stock was 134. So obviously there's a deficit. There's the trading stock, 134,840. And now we've counted 130. So the difference is the deficit. Packing material unused. This is what we have on hand at the end. Although we've spent 23,100 on packing material, we haven't used everything. We have left 3,600 to be subtracted. So let's show that on the income statement or statement of comprehensive income. We know we need to add trading stock deficit. And that is the difference between what we have on hand in our records, 134,840, minus what we have on hand, what we counted, the 135,40. So the deficit will be 4,300. And then the packing material, we said that we have on hand not used 3,600. So that's done. We've earned some marks. We look at the next adjustment. We must adjust the provision for bad debts to 5% of the net trade debtors. The debtors control is 68720. So we must calculate 5% of that and then compare it to the provision of 3936. There is no, like on the slides that I showed you, there is no adjustment to the debtors control. So we take that amount. The second step, we calculate the percentage, the 5%. Third step, we compare with the current provision and then we make the adjustment. So if we look at the debtors control amount, 68720. If you calculate 5% of that, it will give you 3436. This now is the debtors. Currently, the provision is 3936. So we must move from 3936 to 36. So obviously there's a difference of 500 Rand. We must decrease the provision. Therefore, it will be an income on the statement of comprehensive income. So there is our line open for that. Provision for bad debts adjustment. That word is important because that shows it is a nominal account adjustment, and you can show the difference there, 3936 minus the 3436. That will give us an adjustment of 500 Rand. So we decrease the adjustment. The next adjustment, interest on loan is capitalized. Now, capitalized means instead of paying the interest per month or every 3 months or every 6 months, it is added to the loan amount. So we actually pay interest on interest. So they add the interest to the loan. And the loan statement that we received showed the following. The loan at the beginning, then we made payments, and obviously that payments will decrease the amount that I owe on the loan. And now we must add interest capitalized in order to get the closing amount of 327. So how do we calculate that? We work from the bottom upwards in order to get that question mark. 327 plus 86,400 minus 374,600. When we work from the bottom upwards, we change the signs. We reverse the sign. 327 plus 86 minus 374. And that will give you the interest to be capitalized. So let's do that calculation. And that is the interest on the loan. So that will be interest expense. From the bottom, 327 plus the 86,400 that we paid minus the opening balance of 374,600. So the interest, which is capitalized, 38,800. That must be added to the loan. So instead of crediting bank by paying it, we credit the loan and we debit interest expense. Okay, that one is done. Number 4, and this is a very popular one. The rent for March 2020. You read March 2020, you know your year is ending on the 28th of February, therefore that is in advance. So we received 1 month in advance. Received in advance, we must subtract. Take into account that the rent was increased by 875 from when? From the 1st of December. So we've received rent from the 1st of March up to the 1st of December, a certain amount, we don't know how much. And then from the 1st of December, we increased the rent with 875, and we've received an extra month. We've received up to March 2020. Now, there are 2 ways in which you can do this calculation. I'm going to show you both. We know from the beginning of March, we have March, April, May, June, July, August, September, October, November. 9 months. Because 1st of December, they increased the rent. So for 9 months, the rent was a certain unknown. Then for the next 4 months, December, January, February, and March, the rent was that original one plus the increase of 875. And that will give you the amount on the pre-adjustment trial balance, 117,250. And now you solve x. 9x plus 4x plus 4 times 875, which will give you 3,500 to give you 117,250. You can add these two, 9 plus 4, 13x. We want to get rid of the 3,500. We take it to the other side. So we subtract, and then we can solve x, and we get x as 8,750. But that was before the increase. So after the increase, the rent is 8,750 plus the increase of 875, and that will give us 9,625. And that is the amount that we received in advance for March, because we were actually trying to calculate what was the rent for that March, in other words, after the increase. The other method that you can apply is, you can say that of that 117,250 that we've received in the pre-adjustment trial balance, 4 months at 875 to be subtracted. That was the increase, and we've received that for 4 months because we've received up to March. And that will give you 113,750. So that is the amount without the increase. And we know it is for 13 months because we received 1 month in advance. And that will also give you 8,750 per month. And then you just add the 875 and you also get the 9,625. So two different methods that you can use. The moment that it is a percentage increase, then we use this method. But when they give you an amount that it increased with, then you can use any of those two. So we know the rent must decrease because it was in advance to be subtracted 9,625. Number 5, insurance includes the annual policy for 5,820 paid on the 1st of June. Now again, if we look at our financial year starts on the 1st of March, ends on the 28th of February 2020. But we've paid an annual policy on the 1st of June. So if we look at the timeline for insurance, we start on the 1st of March 2019. Then on the 1st of June 2019, we paid the annual insurance, and our year ends on the 29th of February 2020. 1st of March, our year ends 29th of February. But we've paid from the 1st of June, we've paid up to the 31st of May, because we've paid it for a year. But our financial year ends on the 29th of February. So everything beyond that is in advance. The amount that we've paid was 5,820 up to February, but we also paid for March, April, May. So we paid for 3 months in advance, and we know in advance must be subtracted. We paid for the next financial year, so the insurance that we've paid of that 1,455 was for the next year. Therefore, we know assurance is only 20,000. Almost there. Number 6, the water and electricity account for February was not yet paid. You always get an easy one like that, and then you can breathe, because we know water and electricity not yet paid, that is accrued expense. Accrued means we must add. So next to water and electricity, we add the 2,150. A breather, an easy one. And then the last one, interest on fixed deposit is not capitalized. That means we receive the interest, whether it is every month or every 3 months or every 4 months or annually, but we receive, so we debit bank and we credit interest on fixed deposit. And the interest for the last quarter of this financial year was not yet received. They don't give us any amount, so we have to look at the information given. Fixed deposit, we are supposed to receive interest 9% per annum, and the amount for the fixed deposit is 120,000. And we haven't received for the last quarter. So if we show that calculation for the interest on fixed deposit, it was 120,000. We earn interest at 9% for a quarter, for the last quarter, and a quarter is 3 months, because 3 on 12 equals a quarter. Sometimes you see a quarter, or then you see the 4 and you write 4 months. But 4 months is a term. That's a third. But a quarter is only 3 months. And that will give you 2,700. So this is the amount that we are still supposed to receive. And we know it is accrued, therefore we must add 2,700. So that is the second step. We've copied all the information on the income statement. We've gone through all the adjustments. Now we do the calculations. So while we are here, interest income, if we add those two, 10,800. Packing material, 19,500. If you do that calculation, water and electricity, 2,770. And then nothing happened to sales, so we can just copy that amount. We don't have to go back to the paper again, because we've already copied the information. Rent income, 107,625. Now we start with the last step. We complete the income statement. Statement of comprehensive income. Sales minus cost of sales will give you the gross profit. These 3 income items will give you a 155,850 to be added to gross profit in order to give you the gross operating income of 488,650. Then we know we must subtract the expenses, but we have a problem because we don't have sundry expenses. So we can't go any further. We have to start from the bottom because they gave us the net profit. And again, when we start from the bottom, working upwards, we reverse the signs. 311,133 plus 38,800 will give you 349,933. Minus 10,800 will give you 339,133. Obviously, you can check this. 339 plus 10 must give you 349, minus the 38 must give you 311. Now we know that the difference between the 488 and the 339 will be the expenses, 149,517. And we know that whatever is in the block must give you the total at the top. So the total at the top minus everything will give you the sundry expenses, 14,447. And there your puzzle is completed. Like I said, the important part is you must know the format of your statement. And then it is easy to fit in the puzzle pieces to complete the puzzle and get the final picture. That was now statement of comprehensive income. And now we are going to look at the statement of financial position. your second financial statement. Statement of financial position. Now you can ask me why that picture there of somebody taking a picture. That is because statement of financial position is as if you are taking a photo of the business on a certain day, obviously the last day of the financial year. You take a photo and you show what is the position on that specific day. And that is also the purpose. And we know that in the statement of financial position, we see that assets will be equal to your owner's equity and liabilities. So the first part, assets, the second part, your equity and liabilities. So that is the purpose. We want to show what is the financial position on that day. Again, know the format. I cannot emphasize this enough. Please don't be lazy. Study this. The quicker you do this, the easier it's going to be for you, rest of grade 11 and also grade 12. The difference between the statement of financial position that you did sole trader last year and the partnership, only the owner's equity, because last year you only had one owner. Now you have more than one, so you will have a capital and current account part that will be added in order to give you the owner's equity. That's the only difference. Now, when we look at the statement of financial position, what is it that you must remember? First thing, when you look at fixed assets, the fixed assets on that statement refers to the total carrying value of all your assets. So when you see that amount, you know it is the carrying value. That's that one block on note number 3 that you show on this statement. Financial assets, something that you must remember in your fixed deposit, that whenever there is a fixed deposit that will mature within the next 12 months, they will give you that information in a sentence. You have to show it under cash and cash equivalents, because then it's not a non-current asset anymore, it becomes a current asset, because within the next 12 months it is going to become cash. So we show it under cash and cash equivalents. The same principle that we have with the loan, the short-term part of the loan. Next thing, inventory. What do you show under inventory? The counted, the correct on-hand amount for trading stock and consumable stores. So in the adjustment, they will tell you that according to the physical stock take, the following was on hand, inventory, consumables. That is what you show on the statement of financial position, because that is what you have on hand. Not the difference, but on hand. Debtors. Now this is a note that you have to remember in order to get the amount on the statement itself. You start with the debtors control, plus or minus any adjustments. If there's a debtor to be written off, we had to subtract that, or debtor return goods, or we want to transfer a balance from debtors to creditors, we do that calculation. Then we subtract the correct provision for bad debts, the one that it is supposed to be, in order to get the net trade debtors. And we add accrued income and prepaid expenses, because those two are current assets. And that's it. That's what your debtors note looks like, and that will be the amount shown on the statement itself. Cash, yes, we know it's bank, petty cash, and cash float. But if there is a deposit maturing within 12 months, we add it to that. We can also add savings account if they give you savings account. And then be on the lookout for bank overdraft. When the bank is in the negative, please don't show it as a bracket on the statement of financial position. No brackets on that statement. whenever the bank is in the negative, it means it's not an asset anymore. Then it becomes a liability. Therefore, we take it to current liabilities on the statement of financial position. Owner's equity, we know we have capital and current accounts, and we know that we have 2 notes for these, and we will look at the activity on that. Non-current liabilities, remember that you have to subtract the short-term part from the non-current liabilities and then show it under current liabilities. They will also tell you that in a sentence that for the next year we have to repay 10,000 Rand a month. So 120,000 will become current liability. Creditors for salaries, we know we have the normal trade creditors, and then you have the accrued expenses and the income received in advance. But also to be added, creditors for salaries. If there is that one worker that I haven't paid yet, we still owe that money, creditors for salaries, which will be, obviously, the net salary that we owe that worker. Pension fund, SARS, pay as you earn, UIF, and just remember in the pension fund, it is the deduction from that employee as well as the contribution, because we owe both to the pension fund. Bank overdraft must be shown on the statement of financial position. It cannot be included in creditors. Trade and other creditors must be shown separately. We are going to look at activity 2, number 2.2, the same one that we just did, but only number 2.2. We've done 2.1, which was the statement of comprehensive income. Now we're going to do the notes for capital and current accounts, as well as activity 5, number 5.1 and 5.2. Still the same information, still the same mistake, not the 28th of February, but the 29th, because it's a leap year. Partners Josie and May, but now we have to show these 2 notes. Same information, capital at the beginning, current accounts at the beginning, look at the debit-credit balances, pre-adjustment amounts from the general ledger at the end of the year, and then we look at information D. Information C, we've used that in order to do the statement of comprehensive income, and now we look at information D in order to do the statement or the notes to the statement of financial position. The easy amounts, again, like your puzzle, put in the easy amounts first. They gave you the opening balances for Josie and Jay. So put it in, 243.60, which will give you the 600,000. Then if you read through the information under D, you will see that on the 1st of June, Josie increased her capital by 40,000. And Jay decreased his capital by 10,000. And the important sentence there is, these changes were not taken into account because they gave you these balances at the beginning of the year. So they haven't included the additional capital contributions and the withdrawal of the capital there. So read carefully, because sometimes we will say it was recorded correctly. Then it should have been 200,000 at the beginning, then plus 40 to give you 240. But in this case, they said it was not recorded. And 240 plus 40, 360 minus 10, and the total. And this note is very important in order to calculate the interest. So please make sure that you do this note correctly. Read carefully about the increases and the decreases. Current account, format. We won't give you a blank, but you don't know what will be filled in yet. So you must be able to write this down from the top to the bottom. And then you're happy for everything that they gave you. In this case, the profit per statement of comprehensive income. Remember, we've done the statement of comprehensive income, and it was 311133. They gave that to us. Salaries, interest on capital, and there's a bonus. That will give us the primary distribution, and then we get the share in the remaining profit. They gave us the opening balances. The opening balances were given for the current accounts. Josie was a credit without brackets. J was a debit with brackets. That means J withdrew more than he was supposed to, more than what was allocated to him the previous year. That's why it's a debit balance. It's as if he owes that 10,100 to the business. It's as if he is a debtor to the business. That's why a debit balance to be subtracted, because this decreases the owner's equity. Owner's equity decreases on the debit side. Okay, so now we've filled in that information given. Now we can start with the first transaction. Josie took goods from stock for her personal use. The selling price was 9,590. Goods are marked up by 75% on cost, and only the trading stock entry was processed. If one of the owners took stock, we know we must debit drawings and we must credit trading stock. So that would have influenced the statement of comprehensive income. But they said it was processed, so that's fine. We know when the owner takes, it is at cost price, so we must calculate the cost price of what he took. And let's show that calculation here at the bottom. Selling price of what Josie took, 9,590. Cost price, 100 on 175, because the markup is 175. We want to know the cost price, the 100. They gave us the 175. So the cost price was 9,480. So now Josie already had drawings of 26,409. That was on the pre-adjustment amounts. And now a further 5,480 of the stock that he took. So his or her drawings, 3,1889. So drawings for Josie, 3,1889. Jay, they said Jay used a business EFT to settle his personal telephone account of 5,100. That was obviously not yet recorded. The amount given on the pre-adjustment trial balance for drawings for Josie, plus then the 5,100 of stationery that he took for his own use, personal use, 62503. So there's the drawings for J, 62503, and if we add those two, then we see the drawings total 94392. Okay, so we're done with the first two. Josie took stock, Jay used a business EFT. Number 3, the partnership agreement clause for salaries provided for the following. Josie, 113,400 annually, and Jay, 7,800 per month. Make sure to read that, because that's going to make a big difference. J still needs to be multiplied by 12, while Josie already gave you the annual salary. But they say the partners were entitled to an annual increase of 10% effective on the 1st of December each year. So every year, 1st December, they get a 10% increase. But the above allowance were not adjusted with this increase. So this monthly 7,800 does not include the 10% increase. Also, the 113,400 not including the 10%. So we have to calculate. Josie's salary, we first have to calculate per month. So that amount given, the 113,400, if we divide that by 12, then we get his per month salary, 9,450. From the 1st of March, April, May, June, July, August, September, October, November, for 9 months, you will receive 9,450. But then on the 1st of December, it will be increased by 10%. So for December, January, February, for 3 months, you will receive 9,450 plus 10%, which will be 945. 10,395. So there is Josie's salary for the year after adjusted with the increase of 10%. For Jay, it's a bit easier because they already gave us the monthly salary, and then for 3 months, the 7,800 plus 10% plus 780, which will be 8,580, and that will give you 9,940. So there you have the salaries, and we can put those 2 puzzle pieces in the puzzle. Salaries for Josie, 116,235, J, 9,5,940, and that will give you a total of 212,175. Okay, so we are done with salaries. Number 4, interest on capital is calculated at 8% on the capital balances. And on the 1st of June, Josie increased her capital by 40,000 and Jay decreased his capital by 10,000. And it was not taken into account. So we must use that in order to calculate the interest on capital. At the beginning of the year, and this is where we look at that first one, we'll see that Josie, at the beginning, his capital was 240,000. He increased his capital. So on the 240,000, he will receive interest for the whole year at 8%. And that will give you 19,200. Then he contributed another 40,000 at 8%, but that was on the 1st of June. So that will be for June, July, August, September, October, November, December, January and February. So that will be for 9 months that he will receive 8% on that amount, 2,400. So there is his total interest, 21,600. You can also say 240,000 at 8% for 3 months. March, April, May, just before the increase. And for the 3 months, that will give you 4,800. After the additional contribution of 40,000, it becomes 280,000, where he will earn 8% on that for the remainder of the year, the last 9 months, and that will give you 16,800. The total also 21,600. So it doesn't matter which method you use, you choose the method that works for you and you work accordingly. J decreased his capital, so we are forced to use this method, the second method, because he decreased his capital. At the beginning, it was 360,000. 8%, that was for March, April, May, for 3 months, 7,200. Then he decreased with 10,000, so now he can only earn interest on the 350,000 at 8% for the remainder of the year, for the 9 months. 16,000, no, 21,000, sorry. 21,000. So his total interest earned will be 28,200. So we've calculated that. While we are here, let's show you the bonus, because it was already completed there. They said that the bonus is 3% of sales, and the sales was 998,400, and 3% of that bonus gives you the 29952. Also an easy puzzle piece that you can put in early. So that is where that 299,952 comes from. Interest on capital, Josie calculated as 21,600, J 28,200, and a total of 49,800. And then the last one says partners share. So we've done the interest, we've done the bonus, and now the last one says partners share remaining profit or losses in the ratio of their capital contributions at the end of the year. And at the end of the year, Josie's 28,000, J 280,000, J's 350,000. You can throw away the zeros, so 2835. But if you know your tables, you can see that 7 goes into that one 4 times, and 7 goes into that one 5 times. So that's my ratio, 4 to 5. Josie will receive 4 out of the 9 parts, and J will receive 5 out of the 9 parts. But we must first calculate the remaining profit. So if you go back to the current accounts, we know that salary, interest, bonus gives you the primary distribution. We add. That will be a method mark. You just have to add correctly. 124, 140, and the total 291,927. So what is left of the net profit to be shared? The net profit was 3,11133. This is how much the primary distribution took from that amount. So what's left is what can be divided between the partners in a certain ratio, 19,206. So that is the remaining profit, the net profit minus the primary. If we show the distribution at the bottom, we know now that it is the 19,206. So for Josie, 19,206 times 4 out of the 9 parts, 8536, and J, 19,206 times 5 out of the 9, and that will give 10,670. So there is the remaining profit that is shared in the ratio 4 to 5, and Josie receives 8536, J 10,670, and the magic is those two will add up to 19,206. So what part of the profit did Josie receive? The primary distribution plus his share of the profit to give him 176,323. That's his part in the net profit. J, the primary distribution, plus the share in the final distribution, 134,810. And again, the magic, those two must add up to the net profit. Retained income for the year, that was what Josie was entitled to take. That was his part of the net profit. But he only took 31,889 through drawings. So what is left for Josie in the business? 144,434 retained income. What he was allowed to take from the net profit, he only took 31, so 144 left. He started with 22,000 in his current account, so at the end of the year, his current account stands at 166,794. The same for J, 134,810 that he was allowed to take. He only withdrew 62, so what's left? 72,307 minus the balance at the beginning, because he had a debit balance. So what's in his current account? 62,207. And if we calculate that total, 216,741, and if we calculate that total, 229,001. And then if we go to the statement of financial position, it will be this amount, the total balance of the current accounts, plus the 630,000 that will form your owner's equity. Now, once again, sometimes this can be a confusing note for you, but please study the format. Make sure you understand what this is about, what you are calculating. Obviously, if you understand the current account itself, the ledger account, this one will be easy. But sometimes you get confused with all the numbers and when must I add and when must I subtract. But please try to understand the note and then it will be easy for you. Okay, let's look at a statement of financial position. This is now the activity 5 in your activity book. It is page 9 and 10, and in your workbook it is page 7 and 8. We're not going to do the whole activity. We are only going to do 5.1 and 5.2, where we have to complete the fixed assets note, trade and other receivables, as well as the assets section of the statement of financial position. And obviously, if the notes are not required, you have to show calculations. 29th of February, that's the end of our financial year. This time it is correct. And it is the Beatles Traders with partners John Lennon and Paul McCartney. Our financial year ends on the 29th of February, therefore, again, the 1st of March 2019 until the 29th of February. So when you read this, you see this as opening balances at the beginning, and these balances are given at the end because of the dates. Fixed deposit, trading stock, debtors, provision, bank. Bank is unfavorable. They only ask us to show the assets part of the statement. So therefore, we will not put that bank in there. Cash float, income received in advance, accrued expenses, prepaid expenses. Let's first do the note for fixed assets. A vehicle was sold for cash on the 29th of February. You read last day, end of the year, and was properly recorded. Cost of sales, cost price was 150,000. Accumulated depreciation up to the date of sale was given. Selling prices given. Vehicles to be depreciated at 15% per annum on the diminished balance. And then the total depreciation on the vehicles for the year. They gave you the amount. You don't even have to calculate that. And equipment depreciated at 20% on cost. But if you look at the information given, they already completed equipment. Now, if you look at this immediately, this one stands out. So what happened there? The cost price of the equipment, 80,000, total accumulated depreciation. So this equipment is at the end of their lifespan. Therefore, we still use it. We didn't write it off. We didn't sell it yet. We still use it. But we can't have a negative carrying value. So the last time that we wrote off so that that equipment will be shown at least R1. Make sure that when they give you cost price, accumulated depreciation, and it's very close to each other, that the amounts, just make sure that you don't write off more than. Sometimes they will give you a hint telling you this equipment is very old. So that's where that one comes from. Vehicles, they already gave you the cost price because that was given. Disposals at carrying value. Now, carrying value, we know, is the cost price of what we sold minus the total accumulated depreciation that was given. So 108,375. Disposals that will decrease the carrying value, therefore in brackets. They gave us the depreciation, the 5,400. That will also decrease the carrying value, therefore in brackets. At the end of the year, cost price was 580. We didn't buy any new vehicles, but we did sell vehicles. So it was the 580,000 that we had at the beginning minus the 150 that we sold, the cost price of what we sold, to give us the 430,000 at the end. That 150,000 doesn't appear somewhere in this note. You have to remember to subtract that because that was the cost price of what we sold. Accumulated depreciation at the end, it was 224. Then we wrote off another 53,400, but we must remember to subtract the accumulated depreciation on that vehicle that we sold. So the total accumulated depreciation at the end of the year, 235,775, to be subtracted in order to give you the carrying value at the end. Okay, this was a rather easy one because they gave you all the information and no real calculations that you had to make. Just note this, that carrying value at the beginning plus additions at cost minus disposals minus depreciation will give you the carrying value at the end. So without calculating this, you could have calculated the carrying value at the end of the year. Now we move to the part where we want to show trade and other receivables, as well as the statement of financial position, the balance, the assets part. I've just copied the information again. We start with additional information. Additional information 1 was the fixed asset note that we've already done. Again, the format, this is what the note looks like. Trade debtors minus the provision gives you the net trade debtors, accrued income, prepaid expense. You have to study this. The statement of financial position, they gave us the fixed assets because now they include it in their land and buildings. And then we also know we have to put in fixed deposit format. Because we know the format, we know fixed deposit to be added here, and fixed deposit was given as 200,000. The same as the statement of comprehensive income, we copy from the question paper onto the answer sheet. Inventory was given as 155,400. Trade and other debtors, the note was asked, and cash and cash equivalents, there was a 5,000 cash float. And then you get the total assets. Additional information 2 says that the statement received from Star Bank showed interest received for February that has not yet been recorded by Beetle's traders. So it's only for 1 month. And interest is capitalized, so it must be added to the fixed deposit. And then they also tell us that 80,000 of the fixed deposit will mature on the 30th of November. So the first thing is we must calculate the interest. The fixed deposit, 200,000. They showed us that the interest is 9% and we haven't received, or it wasn't capitalized yet for February. That wasn't recorded yet, so only for 1 month. So that will give you 1,500. And we know it's capitalized, therefore it must be added to fixed deposit. It's not an accrued income. It's capitalized, we add to fixed deposit. Then they also said that 80,000 of the fixed deposit will mature on the 30th of November. So within the next 12 months, 80,000 of the fixed deposit will mature. I take it out from the non-current and I show it as a current asset under cash and cash equivalents. We've done that on the slides. I've shown you that. So please be on the lookout for this, where they tell you that some part of the fixed deposit will mature. Number 3, a physical stock count revealed the following closing inventories on hand: trading stock, packing material. We've already put the 1554 there because that is the on-hand one. That's the correct one, irrespective of what is shown on the pre-adjustment balances, but that was also given 155,400. On the 29th of February, but remember this was done on the 28th. On the 29th of February, the next day, the day after the physical stock taking, trading stock with a cost price of 50,000 was stolen during a robbery. But the insurance company agreed to pay out 80% of the claim during March. So there's a 80%, and if you calculate 50,000 times 80%, gives you 40,000. So there's a 40,000 that we're still supposed to receive for this financial year because the robbery happened in this financial year. So that will be accrued income that we show on the accrued income note. Accrued income, the 50,000 times 40 times 80%, times 80%, which will give you the 40,000. And also on the statement of financial position, we've counted 155,400, but 50,000 was stolen. So I can't show it as part of my stock. And then we have packing material on hand to be added to give you the inventory amount on your statement of financial position. And then the last one says that the provision for bad debts must be adjusted to 5% of debtors. Our debtors, 78,000, and 5% of that will give you 3,900. And we know the provision to be subtracted because that will decrease the possible debtors, 7,100. And then on the amounts given, prepaid expenses, 3,400. That was a given amount, 117,500. But because I know the format, I know I must look for this. That was with an adjustment, but this one I had to look for, prepaid expense. They were also given income received in advance and accrued expenses, but that will be under trade and other payables. So now we can complete the statement of financial position. They gave us, or we've calculated the trade and other debtors, 117,500. Cash and cash equivalents, 85,000. The total current assets 311,500. Fixed deposit, the 200 plus the interest minus the part that will mature, 121,500. Total non-current assets. And if you add the non-current assets plus the current assets, will give you the total assets. So once again, this is like putting a puzzle together. You must know the format. So after the session, the thing that you must remember is learn the format. That now was the statement of financial position. Now we're going to look at your favorite, which is the analysis and interpretation. We're going to look at the ratios, what each of them means, and then we're going to do 2 activities on that. So let's look at analysis and interpretation. The first thing is, what is the purpose of analysis and interpretation? Why do we do this? Obviously, we want to take some steps for future. We want to plan for the future. We want to see what the figures mean. There's no use of preparing a statement of financial position and statement of comprehensive income and then just put it away and never look at it again. Those figures must tell us something. It must tell us what happened during this year. We compare it with the previous year, and then we also use it to plan for the next year. So those figures are important on the statements, and we must get some information from that. And that's the purpose of analysis and interpretation. So you must know and understand the indicators. It's one thing just to study them, but you must understand them. Also, you must know where to look for information. If I get into somebody's cupboard, kitchen, and I don't know the house, I don't know the kitchen, then I start looking for a mug, and I don't know where to find it, so I open all the cupboards. But if I know exactly where they put the mugs, I just go and open the cupboard and I take out the mug. The same with analysis and interpretation. You must know where to look for the information. Sometimes we give you a lot of information, but you must know, do I look in the statement of a comprehensive income, or do I look at the statement of financial position? Know where to find the information. Let's look at the financial indicators: profitability and operating efficiency. There are 5 of them. Liquidity, a famous one to test, liquidity 6. Solvency, we have 1 ratio. Return on investment, we have 3 for the partnerships. We will teach you more next year when we do companies. And then we have risk and gearing, where we teach you actually only 1 this year. The other one will next year, but I am going to show you that one as well. And then on page 11 and 12 on your notes, there's also an explanation of these indicators if you want to look at that. The first one, profitability and operating efficiency. Now, the question that you must ask, or the question that can be asked, is how profitable is the business? Or how well does it control its expenses? So whenever you get a question like that, you know you have to look at these ratios. How effective is the business in its operations? Operation of buying and selling, normal day-to-day activities. We look at gross profit on sales, percentage gross profit on cost of sales, operating profit on sales, operating expenses, and the net profit on sales. Now, just to clarify something, for instance, the net profit, percentage net profit on sales. Say this is 14%. That means for every 1 rand sales, we have 14 cents net profit. So what happened between sales and net profit, all the expenses? So there is 86 cents gone. We only kept 14 cents. So obviously we want this one to be as high as possible. The percentage gross profit on sales, percentage gross profit on cost of sales, that's your markup. We always give you the markup of 25% or 75%. That will be that one. And sometimes when we calculate it at the end of the year, this percentage did not realize for different reasons. Percentage operating profit on sales as high as possible, but then we get the operating expenses on sales. If we say that percentage is 60%, that means for every R1 sales, we spend 60 cents on expenses. So obviously we want this percentage to be lower, because you must compare and you must say whether it improved or weakened. So if this one goes down, it's good. If this one goes down, it's not good. So try and understand what each of these indicators tell you. The next one, liquidity. The questions that can be asked: can the business repay its short-term debt? Important, short-term, within the next 12 months. Can they repay that? Are there any cash flow problems? I need money in order to pay. I may have a lot of vehicles, I may have a lot of property, but I can't pay with that. I need money to pay. And the financial indicators there will be your current ratio, asset test ratio, stock turnover rate, stock holding period, debtors collection, and your creditors payment period. You can see the picture here. It is liquid, water flowing, money flowing. That is what liquidity is about. Now, normally those two go together, current ratio and the asset test ratio. These two go together. Stock turnover rate, how many times do I replace my stock? Stock holding period, for how many days or how many months do I have stock on hand? Obviously, this will be determined by the type of product that I sell. If it's clothes, it is seasonal. If it is groceries, perishables, it will differ depending on the type of product that I sell. Debtors collection period, we are aiming for our debtors to pay us within 30 days. And then we want to keep our money as long as possible, and we negotiate for a period of 60 to 90 days for our creditors to pay them. But those 6 ratios refer to liquidity. Solvency, only the one question that we can ask: can the business repay all its debt? Not only the current debt, but all its debt. And the financial indicator there is your owner's equity or net assets. Net assets being total assets towards your total liabilities. Now, if this ratio is 2 to 1, it means for every R1 debt, I have R2 assets. So yes, I will be able to cover all my liabilities. If I sell all my assets and make it money, then I will be able to cover my debt. If this ratio is 0.5 to 1, it means for every R1 liability, I only have 50 cents assets. So now I am actually insolvent because I can't repay all my debt. Why do we refer to owner's equity here? Net assets will be assets minus liabilities. Owner's equity equals assets minus liabilities. So that is where that comes from. But again, it is, can they repay all their debt? Return on investments, the question to be asked: do the partners earn a good return on their capital invested in the business? They could have taken the money and invested it in the bank, but is this a better investment? And we are looking at the percentage return on the average owner's equity, percentage return earned by each partner, and then the amount. This is for the business in total. How much does the business earn? And we will always compare this with the interest rate on other investments, because the alternative was that you can put your money in the bank, a risk-free investment at a certain percentage. But if I have a return of 32% in the business, obviously no bank is going to give me 32% on any investment. Therefore, this will be a good investment. So this is what I compare it to. The last one, risk and gearing. Questions to be asked: to what extent is a business funded by borrowed capital? And to what degree does it affect the financial risk? Can the business borrow more money? And is it worth it? Is it worth to borrow the money? Am I using that borrowed money effectively? And the two ratios that we are looking at, debt equity ratio and the return on total capital employed. Now, this is the one that's actually only in grade 12. But on the activities that we're going to do, I'm going to show you how you work that one together with the debt equity, because the debt equity is about the risk, debt, borrowed capital, equity, own capital. While the return on total capital employed, the total capital employed will be your own capital, which is the owner's equity, plus the long-term loans, the return on that, and that is going to be compared to the interest rate on loans. How effectively am I using the borrowed money? How do we answer these questions? You don't, or I understand that you don't like these questions, but how do we answer these? The first thing, you identify and you name the financial indicator. They ask you a question, and you must know your indicators. When is it on liquidity? When is it on solvency? You name the financial indicator. You show figures, always. Always. Even if they don't ask for figures, you show them, always. Then you compare with the previous year. Did it improve or did it weaken? Now, in some cases, we don't provide you with the previous year's figures. Then obviously you can't do that, but that is normally your first step. You compare with the previous year. And then you ask yourself, what is acceptable? And to what must it be compared? Do I compare it to the interest rate on the fixed deposits? Do I compare it to the interest rate of loan? To what do I compare the results? And then finally, you must have a general explanation or a general comment on the question that they asked you. We are going to look at activity 1, number 1.1, and then activity 4, only 3 of them. Now, this one is a very nice one because you complete the statement of financial position by only using financial indicators. So let's look at those activities. The first one in your activity book, page 13, and then in your workbook, page 9. We have the 2 partners, S and J Mkuni, from Mkuni Stores. They sell a range of hardware items to the public, and 90% of sales are on credit, and all the purchases are on credit. And now we have to complete the statement of financial position on the 31st of August. In other words, my year started on the 1st of September 2018 until the 31st of August 2019. There's my financial year that I'm working in. And then they give you information, only that. And then you have to complete the statement of financial position, the whole thing. Now, maybe you will not see this in grade 11 in a final exam. Maybe you will do something like this in class. I hope you do. But this is important for preparation for grade 12, because in grade 12 very often they will use financial indicators for you to complete part of the financial statements, part of the statement of financial position specifically. So I'm just going to show you how to put this puzzle together. It's really very nice using the information given to see where it goes, and then your statement just falls in place. So let's start. First step, obviously, format. I think I already said, you will remember after the session, format. You must study your formats. Current assets, inventory, trade and other debtors, cash and cash equivalents. Partners' equity consists of capital, current accounts, the current accounts already given, where the total is a debit balance, a minus bracket. Non-current liabilities will be your loan. Current liabilities already given, creditors, and they gave you the total equity and liability. So obviously the first thing we can do, we know total equity and liabilities must be equal to total assets. So there we've got 1 mark, just because we know that those two must be equal. When we look at the information, the current ratio for 2019 is 2.5 to 1. Current ratio will be your current assets towards your current liabilities. And we know that is 2.5 to 1. But they gave us the current liabilities. They said that the current liabilities is 95,000. That was given. So if the current liabilities is 95 and the current assets is 2.5 times more than that, then I can put in the current assets. That must be the 95,000 times 2.5 in order to give you 237,500. There you have another 2 marks. So information A, we've used that one. Information B, they show you sales for 2019 amounts to 1152. Markup of 50% on cost. So we know we can calculate cost of sales. They also give us the stock turnover rate. Now, we know that sales and cost of sales nowhere to be shown on the statement of financial position. But when we read number C, the stock turnover rate for 2019 was 8 times and was constant throughout the year. So those two go together in order to get the trading stock. How do I know that? If you know your ratios, you will know that the turnover rate equal cost of sales divided by your trading stock. If we calculate the cost of sales, then we've got that one. They gave us the turnover rate, then we can calculate the trading stock. So cost of sales was the sales 1152 times 100 on 150, because they said the markup percentage is 50%, and that will give you 768. So that's the cost of sales. So if we fill that in, the cost of sales divide by the trading stock will give me an answer of 8. So now I want to know the trading stock. So trading stock will be equal to 768,000 divided by 8 in order to give you 96,000. All that you do there is you are just rewriting that equation so that you get the trading stock on its own. I want to get rid of this. I multiply by trading stock. I multiply by trading stock on the other side of the equal sign. But then I want to get rid of the 8. So I divide by 8. I divide by 8 on this side. So I'm actually just swapping those two. but there is a mathematical reason behind that. But you just swap the two, so there's my trading stock. Another piece of the puzzle. Trading stock, 96,000. Next to inventory, 96,000. Another 2 marks. Information D, so that one's done. Information D, on the 1st of September, the business had a bank overdraft. 1st of September, the beginning of the year, had a bank overdraft of 50,000. So we started with a negative 50,000. During the year ended, at the end of the year, the bank increased not to 60,000, but by 60,000. So we received a 60,000. So now we know our bank account must be 10,000 because we started with a minus 50,000. Then there was an inflow of 60,000. So now our bank balance will be 10,000. Okay, so another piece in the puzzle. Number E, the net profit for the year ended at the end of the year, 126,000. Okay, now we know we don't show the net profit on the statement, so I must read the next one as well. The return on average partner's equity, this was for the business. The return was 28%, and then they give us the 2 partners their earnings. But we are looking at the business. So those 2 actually go together, E and F, because if you know your ratios, you will know that the return equals net profit divided by owner's equity. And we want to calculate the owner's equity because they gave us the net profit. The return equals your net profit divided by your owner's equity. They gave us the net profit, 126,000. We want to know the owner's equity. And they said that this is 28%. So exactly the same as the previous one. We actually just swap those 2. So we know that the owner's equity equals 126,000 divided by 28%. And that will give us 450,000. So there is our total owner's equity. So if we go back to the balance sheet, there's another piece of the puzzle, 450,000. But now I know whatever's in the block, the total is at the top. So if 450 plus 50, this must be 500,000, because 500,000 minus 50 will give you 450. And then the last piece of information, debt equity ratio, 0.15 to 1. Debt equity, long-term liabilities towards your equity. Now we've got the equity, we want to calculate the long-term debt. Debt equity ratio the debt equity ratio equals 0.15 to 1. But we've already calculated the equity. This one, we've calculated that as 450,000. So we can calculate the debt. The debt will be equal to 450,000 times 0.15 to give us 67,500. So on the balance sheet or the statement of financial position, we can put in the loan. Now I know there was an actually easier way. The 450 plus the 95 subtracted from the 612, because we know that the partner's equity plus the non-current plus current must give you that one. So if we do that calculation, we will also get to 67,500. 67,500. So the bottom part is completed. We know that the partner's equity plus non-current plus current will give you the total equity and liabilities. At the top, we still need to complete this one, but now there's a space. They didn't give me any information on debtors, but I know 237 minus those two will give me the debtors, the missing amount, 131,500. And then I still need the fixed assets, but I know total assets minus my current assets will give me the total assets. And again, my non-current assets plus current assets will give me the total assets. And there's your statement of financial position, without any sentences, without any adjustments, just by using financial indicators. The last activity that we're going to do is in your activity book, page 16, 15 and 16, I think, and then in your workbook, page 15 and 16. They give you a lot of information. Again, read the headings. The detail of the partner's contribution, capital contribution, on the 30th of June at the end of the year. Extract from the current accounts of the partners, and then they give you financial indicators. So that is the information given. And also there at the bottom, they tell you the loan amount, 450, and the interest rate on loan, 14%. Now the first question, calculate and comment on the percentage return earned by Sharu. And you have to use the average owner's equity. Now again, you must know your ratios. The earnings of a partner, I've shown you earlier when we did this note, will be his part of the net profit, which will be the primary distribution and the final, the salaries, the interest, the bonus, plus the final. That is his earnings. That is his return in the business. And his average investment will be his capital at the beginning of the year, plus his capital at the end of the year, plus his current account at the beginning of the year, plus his current account at the end of the year, divided by 2. So the 320 divide by the average of those 4 amounts. So let's write that down. 320,000 was his earnings or his return on his investment. Divide by 0.5 times opening balance of capital, opening balance of current account, closing balance of capital account, closing balance of current account. It's a percentage, so we times by 100. And that will give you 32.6%. You don't have to calculate this and show that, but you must show this calculation. That one is the important one. You can show that as 320,000 divided by 983 times 100. You can show that. Or if you can just calculate it once off, you write the answer. So that was his return, 32%, almost 33%. Now, obviously, this is much higher than the interest rate on an alternative risk-free investment. If you go to the bank will not give you 32, 33% on any investment. So yes, this is acceptable, this is good. They did not give us the previous year's information on his return, so we can't do that step. But we know we must compare it to the interest rate on fixed deposits. The next one, the debt equity ratio. Again, if you know your format, you know you look at debt, which will be the loan given here at the bottom, 450,000, divide by your owner's equity. Owner's equity, which will be the total capital, because this is now for the business. It's not for one partner only. For the business, the 1.6 million plus the 181,200. So what is the ratio between own capital, these two, and borrowed capital, the 450? And without calculating it, we can actually see it is acceptable. The loan is only 450,000. But we have own capital 1.6 million plus another 181,200. So this ratio 450 towards a 1.781200 million, which will give you 0.321. Meaning, for every 1 rand own capital, we only borrowed 30 cents. Therefore, we know it's low risk, which is asked in number 4.4. The partners have planned extensions to the buildings to the value of 100,000, and now the one partner, Shiru, suggests that they borrow money, additional loan for 100,000. And you must say whether you agree or not. 2 points. Actually, 2 ratios that you must quote with figures. They ask you, do you agree? That's a mark. Yes. So answer the question, yes, and then you must prove that or motivate that. The first one, the debt-equity ratio, has improved. Remember I said the first thing is you compare with the previous year. It was 0.5 to 0.3. So the previous year, they borrowed 50 cents for every 1 rand own capital. Now we only borrow 30 cents for every 1 rand own capital. So that's low risk, and we don't depend too much on borrowed capital. Even if we borrow another 100,000, if you look at this ratio, then it will be 550 towards 178,200. So it is still low risk, still acceptable. This is after we borrow 100,000. You can show that calculation if you want to. The next reason that we're looking at is that ratio, that grade 12 ratio, the return on total capital employed, the ROTCE. First step, what happened from last year to this year? It improved 38 to 40%. To what do we compare that? To the interest rate on loans, 14%. So we make use of the bank's money and we have a return of 40%. But we only have to pay 14% to the bank. So we take the money, we have a return of 40%, we give the bank the 14%, and the rest is profit or return for the business. So they are using the loans effectively, and we say they are positively geared. Debt equity refers to the risk, low risk, because we don't really depend too much on the borrowed capital. We will be able to repay the loan. If that one is 1-to-1, it means for every 1 rand own capital, we borrowed 1 rand. That's high risk. But the return on total capital employed refers to the gearing. Positively geared. Why? Because the percentage return is more than the interest rate on the loans that we have to pay. And that is the total for the revision for term 2, and I really trust that this will help some of you, that maybe you've learned something new today and that you are motivated to work on your own through the rest of the activities. You all have the workbook, you have the activity book, you have access to the answers, so please practice this, and may you all be well prepared for your tests and your exams that lay ahead. Good luck for the rest of the term. Thank you.